Good evening, everyone. A very warm welcome to one and all. I am Sriram Subramanian and I head marketing for IndiaBonds. NISM and IndiaBonds together bring to all of you an exciting series of educational webinars on the Indian debt market and are committed to making the Indian bond market more accessible and transparent. We are delighted to host today's sessions and even sessions like these. This to simplify the Indian debt market and bring you some amazing insights from industry leaders. Today's agenda of the educational webinar will be an introductory session by Mr. Sashi Krishnan, Director NISM, followed by a knowledge session on debt markets by Mr. Vishal Goenka, co-founder IndiaBonds, and a Q&A session. With that, I'd like to pass it over to Mr. Vishal Goenka, co-founder IndiaBonds.
Sriram, thank you. A very good evening to all of you. Good afternoon to all of you. Thank you for joining. This is a series 7th or 8th webinar we are doing, and we usually get a very overwhelming response for an asset class called fixed income. I think some of it is due to an equity wobble. People are looking to diversify assets and their portfolios, and some because thanks to technology, the knowledge dissemination is amazing. We are very grateful to partner with NISM because, building capacity in the capital markets is the main mission of NISM. And today we're very lucky and fortunate to have the director, Mr. Sashi Krishnan, with us. Over the years, but more about NISM, I will leave Mr. Sashi Krishnan to talk about. As the agenda goes, we'll hear some introduction about the bond market. I'm going to run you through a small training module just to give you a background. I have been a trader, global markets, fixed income for over 20 years. I worked in Merrill Lynch in London, in Deutsche Singapore, and now it's our passion to introduce fixed income to everyone in India. It'll be followed by a Q&A. This is usually the most exciting time. We leave about 20 minutes to 30 minutes. You can type your questions in the chat module, and we will try and answer as much as we can so that it's a really an interactive and informative session as such. Without further ado, Mr. Sashi Krishnan, I pass the floor to you. I would love to hear insights from you about NISM and also about the bond markets in India. Having been a professional for over 40 years experience in various capacities and institutions, we'd love to share some wisdom from you, please.
Thanks, Vishal. Thanks, Sriram. And welcome to this webinar on bonds and the bond market. NISM has been set up primarily for capacity building in the securities market. And I think our objective is to try and touch as many people as we can to make them understand, the nuances of the securities market. And I think the time has come, as Vishal was saying, to ask the question as to why not bonds? Because I think, we keep talking about stocks. And if you're lower down the value chain, you talk about fixed deposits. But, we somewhere have lost that middle. And I think the time now has come to talk about bonds. And, I particularly am very keen to talk about it because I have been a bond fund manager for a very long time during my career in the securities market. And whereas Vishal will talk to you about the how and the when, if I'm not mistaken, of bonds, I wanted to start off with the why. Because I think the why is also very important. And, most of us, especially retail investors, need to sit back and ask ourselves this question as to why do we need bonds in our portfolio? And the second question as to why do we need those bonds in our portfolio? The answer to the first question is, I think most definitely you need bonds in your, in your personal portfolio. And the reason why you need bonds is that bonds have predictable cash flows that can meet specific goal-based needs. And I tell you this from experience because I came to NISM after managing the National Pension System Trust. And there is no other sort of financial goal more important than retirement. And the most important thing that you need in retirement is predictable cash flows. I mean, I don't think you can imagine retired life without predictable cash flows because you have no other source of income at that point of time. And therefore, I think the need for sort of bonds in your portfolio at that stage of life is, there is no sort of two sort of thoughts about that. The second sort of very, very important thing as to why you need bonds in your portfolio is the fact that this is the only asset class that can preserve capital in the true sense of the term. And if you look at, the worries that people have in terms of whether these bonds will default, and, whether we will get our interest payments, which will protect our cash flows. I think, the comfort that I would like all of you to draw on is the fact that if you look at the CRISIL statistics, for the fiscal 2024, just about 1.3%, was the total annual default rate. And if you look at the default rates for, say, AAA bonds, it has been 0. If you look at the default rates for, say, AA paper, it has been something like 0.31. And even for A-rated paper, it's just been around 0.69. Very, very low. So I think without doubt, capital preservation is clearly an object that bonds bring to your personal portfolio. Thirdly, what are the other asset classes that that normally come to mind for many of us who are, saving and investing? FDs. The problem with FDs is they don't beat inflation. And if you really need an asset class that is low risk and still beats inflation, then you must look at bonds as a substitute to FDs, right? What about equity? Because I think, all of us are fascinated with equity. Most people who get into these in markets today, the first thing they touch is equity. I know many of you, also tend to touch equity derivatives, but, that besides. But equity is an extremely volatile asset class, right? And therefore, it is time that we start thinking about the fact that if we need to protect volatility, then how exactly should we be approaching this? And then bonds is the answer to that. And the third thing that I thought I wanted to leave with you was that for a very long time, many of us were investors into debt mutual funds. And we continue to invest into debt mutual funds, especially at the short end of the market. Because at the short end of the market, sometimes it's easier to access the debt mutual funds, especially the liquid funds and the short-term funds, and maybe the money market funds. And it's easy to exit them, and they're very convenient that way. But I mean, if you go into the medium term and the longer term debt funds, the problem fundamentally is that one of the reasons all of us got into it was the fact that there was a tax advantage that was available to us, and that tax advantage is no longer available to you. So why not bonds? Because you can sort of do exactly the same thing that you want to do in your medium term and long term, that you were getting out of your medium term and long term bond funds. So there is a case. And if you put some numbers together, and if you look at, say, the returns that you would have got in a portfolio that was 100% invested into equity, say, over the last, say, 20 years or so, say 2005 to 2025, equity gave you over this, 20-year period, a CAGR of something like 13% or maybe slightly more than 13%. But it came with a volatility of 26%. And when I'm talking about the volatility, I'm talking about the standard deviation. If you, on the other hand, had a portfolio which had 60% equity and 40% debt, and I'm measuring equity returns on the basis of the Nifty 50 returns, right? And you had a portfolio of equity and debt, this combination would have given you lower CAGR, no doubt about it. CAGR of, at best, something like 11.5%, which is almost 150 basis points below what you would have got in a pure equity portfolio, but with a substantially lower volatility of just 16%. Now, look at it in terms of numbers. That is, if you put in 1,000 rupees, or say 10,000 rupees into, just into equity, into the index, 20 years down the line, you would have got something like 1,15,000 rupees, right? But with volatility of 26%. There's ups and downs and the zigs and zags of the equity market. But if you had put it into a portfolio which had 40% debt and 60% equity, your 100 bucks would have become 880 rupees. So definitely lower than that 1,000. Your 10,000 rupees would have become 88,000 rupees for, simpler understanding. 88,000 rupees as against 1,15,000 rupees, but so much lower volatility of, just around 15-16%. So I think there is a very clear case for us to actually, think about why we shouldn't, look at bonds in our portfolio. And I think Vishal will touch upon this to a great extent in the, session that we are doing, because it's much easier now to buy bonds. And I think that's what I want everybody to buy into, because with online bond purchasing platforms that are available today, I think, accessing bonds is no longer as difficult as it used to be, till a couple of years back. And I think, today there is a lot more information available, especially in the Bond Central platform, where you can actually get, literally every bit of information you want on the bond. And more importantly, you can also query that platform to find out that if you wanted to invest into a bond with, a 10% interest rate, which is AAA rated, which is, a maturity of 10 years, what are the bonds that are available? And then go back to some of these bond platforms to see whether you can get those bonds. So what is holding us back? And that's a question I think all of us need to answer. And I think 2-3 things are holding us back. One is the lack of awareness. And I think the session that we are going to have today is basically to address that problem. And I think Vishal will sort of, take us through a presentation which will, to a great extent, clarify a lot of what we didn't know and what we need to do. The second, I think, is, there is an inherent complexity in the product. And I think, people will talk to you about YTM and duration and credit ratings and a whole host of things. And I think, we will demystify that for you in this particular session that we are going to do today, so that, it is much easier for you to adapt to this. The third thing is that, irrespective of the fact that, bonds are now available on platforms like this, there are problems relating to transparency. There are problems relating to liquidity, real-time price discovery, execution, etc., which I'm sure technology will take care of. And as the platforms become deeper and there is more and more sort of, trading happening from retail participants, these problems will get addressed. So much for the why. And Vishal, if I may take 5 more minutes, I just wanted to, talk about a couple of other things as to why the bond markets are going to be really very important in India. See, today's India's GDP is something like around 296 lakh crores. So you translate that into, USD, something like $3.57 trillion. Compare that with the US. US's GDP is close to around $30 trillion, 29.16 to be exact. Now, if we are aiming to grow at 11%, by 2047, we aim to be a 30 trillion economy. Okay. And we're going to get there sooner than later. But look at the size of the Indian bond market today, right? Today, the size of the Indian market is just something like around 2.56 trillion, right? That is just 72% of our GDP, 2.56 trillion out of 3.57 trillion. Look at the US markets, markets that have, embraced bonds, to a very, very, dramatic extent. The size of the bond market in the US is something like 53 trillion. Now, 53 trillion against a US GDP of something like 30 trillion means that the size of this bond market is something like 183% of GDP, right? So if you translate this back to saying that we are going to become a 30 trillion economy by 2047, and at least our bond market will be 100% of that, not 183%. I'm not getting anywhere near there. We still will be a 30 trillion bond market. And therefore, we are going to be a 30 trillion bond market as against something like a 2.56 trillion today. So that's the extent of growth that I see in the bond market. And therefore, it is very important that every one of us, attending this webinar gets familiar with, what bonds are and why should we be there in bonds. The second thing that I wanted to sort of leave with you is that today a large part of the bonds are government bonds. So, you have government bonds, SDs, etc. The corporate bond market is just around 22% of the total bond market today. But I think this is something that's going to grow dramatically over time, because the advantages that you will get from enhanced yield, ability to, take larger exposures to different areas of the market, etc., will come from the corporate bond market. And therefore, I think, there is a tremendous sort of growth that we are going to see in the, bond markets in India. And I think that's the reason why we thought we should do a webinar like this to familiarize you with the bond markets. So over to you, Vishal, to take us through the rest of this webinar.
Thank you, Mr. Krishnan. That was amazing. Years of experience put in 10 minutes. But absolutely resound with you. Till 2 years ago, you could not buy a bond. Today, bonds start from 10,000 rupees. And thanks to SEBI regulatory framework of online bond platforms. So I'm going to jump straight into some of the basics, because I think, as you said, building awareness is the first primary step. And this whole webinar is kind of dedicated. And then there are various ways to find the information. I'm going to tell you where you can go and find more information. If you please. So today is about navigating the bond market and how and where. Happy to take technical questions. I can see some questions coming up already. Just hold on to that. We will answer the questions right at the end. Let's start. Next slide, please. Today, we're going to learn basics, bond market size, types of bonds. Who are these participants? Some very important pitfalls to avoid and must do about portfolio allocation and OBPs. Very simply, a bond for most of the people is nothing but a loan. It's like your friend or your cousin says, hey, can I borrow 10,000 rupees from you for a year? And you say, okay, Ashish, here is 10,000 rupees. At the end of 1 year, you give me 11,000 back because I've blocked my money. You say, yeah, that's fine. That is simply what a bond is. In this case, the issuer is a company or a government, right? So government is borrowing money from the investor, and the bond is a prescribed agreement, right? Today, you trust your friend, word of mouth. He says, I'll give you 11, give me 10,000, I'll give you 11,000. But that document is called a bond. A bond is like a promise that, okay, I will pay you X amount. So everybody, actually, bonds or loans or giving money to people at an interest rate has existed for hundreds of years. All that bond does is puts it in a structure, in an information memorandum, and that's how you can invest, because you cannot have 100 friends or 50 friends, Ashish, who you trust, and this format gives you that thing. On the right, the main points to look at: the company is called the issuer or the borrower, a government agency or a company or a state government. Face value means the minimum amount to invest is gone down to 10,000 rupees, thanks to SEBI's proactive action to make bonds accessible to everybody. It is 10,000. Interest rate is also called the coupon. This is fixed at the time of the issue. For example, if Ashish, your friend, were to borrow money from you for 2 years, then after 1 year, he'll pay you 1,000 rupees. And at the end of 2 years, he'll pay you, 1,000 plus your principal back. Credit rating is what we're going to talk about in detail. Because this is an agreement between you and the company, there are agencies which give a credit score to these companies so that you can help you decide a little better. Maturity is the date when your original loan comes back to you. So if you've borrowed money or invested money for 2 years, the company has a maturity date already of the security. Your principal with interest comes back. So that is absolutely the basic to demystify. Bond is just a loan. Sorry, 1 second. Yes, someone is asking, is there a presentation being shared on the screen? Okay, yes, there is a presentation. Can people see the screen, please? Can I ask the audience and a couple of you say yes? Okay, yeah, so most of the people can see yes. Okay, that's great. Oh my God, amazing response. There are 3-4 no's, but 95 to 99%. Okay, that's great. We've got about 100 responses. That's a very proactive audience, I must say. So that's amazing. So basically, Nothing. Bond is also called an NCD, non-convertible debenture. There's no difference. Companies issuing bonds are called debentures as per, usage of term, but it's the same thing. Great. Let's move on to the next slide, please. This is what Mr. Krishnan alluded to, the size of the Indian bond market. So if people are saying, "Arey yaar, bond kisko aata hai, it's very small," it's not. In the Western world, as you see on the left bottom chart, the bond market is 200% of GDP or of equity capitalization, or 113 or 120%. In India, I've taken equity market capitalization, we are only 57%. Hence, the important thing is that the tremendous opportunity to grow. It's not like a small structured product that you don't know what is happening. 2 trillion bonds are outstanding by the government, about 600 billion by companies. Let's move on. Bonds are basically divided by the type of the issuer. So on the left, they are issued by government bonds is by Government of India, which is also called risk-free. So GSEC, government security, we call it GSEC. So for people who want to start bond investing, government security is very, very good. And because it's issued by the government of India, it's considered risk-free. Like US Treasury or US government bond is considered risk-free. It's a good place to start. Also, because interest rates in India are coming down right now, and interest rates follow 2-3 year cycles. So it's a good time to lock in some of the higher yields. Okay, someone is asking to go back to the previous slide. Maybe you want to take a picture. Can we have the previous slide for 2 seconds, please? Great, let's move on. I'm just trying to be proactive, so it's an interactive session. Let's go on. Next slide, please. SDL is issued by state governments. SDLs are guaranteed by Government of India. And T-bills are treasury bills. Treasury bills are bonds or loans taken for less than 1 year. Corporate bonds are issued by companies. State guaranteed bonds are actually corporate bonds. What do I mean by that? UPPCL, Uttar Pradesh Power Corporation, Karnataka or Kerala Infrastructure Finance. These are companies owned by state governments, and they are guaranteed by the state government. It is not guaranteed by the central government. PSU, public sectors issue a lot of bonds like REC, Rural Electrification Corporation, National NHAI, they issue bonds for building infrastructure in the country. Banks issue bonds, and NBFCs, which are non-banking finance companies, and also other corporations. So always know if your risk is government securities or corporate bonds. Someone mentioned municipal bonds. Absolutely. They fall under the category of corporate bonds. Next slide. Very, very important. There was a question here, listed versus unlisted. I will, even SEBI, the regulator, SEBI regulates the issuance of corporate bond market, and RBI regulates of the government bond market. Always buy listed debt security. There are a lot of platforms in the country which offer you securities which we call are unlisted. What does listed debt means? Listed means it is listed on NSE or BSE and importantly regulated by SEBI. So if something were to go wrong, you always have the regulator that you can go to. Listed is also more liquid because it is on the exchange and you can trade it. Unlisted securities are merely governed by Companies Act. If anything were to go wrong, there is no regulator to help you. So as retail investors, always check it is listed securities. Listed have a compulsory need to report financials. Like every quarterly, you'll get a financial update and things like that because they have to release it to the exchange. Unlisted issuers can actually choose not to show you the financials of how the company is doing. And there is nothing you can do about it. So even though unlisted might offer you, attract you at like, hey, 15%, 16%, please be careful because if something were to go wrong, there'll be no regulator or regulatory framework to help you. Next slide, please. Secured versus unsecured. So someone asked this question earlier. What is secured? Now, remember that friend Ashish who you gave 10,000 rupee to? If Ashish tells you that, hey, if I don't give you your money back, here's my mobile phone, you can take my mobile phone. Now that becomes a security that in case something were to go wrong. All of us are used to what a secured loan is because when you take a mortgage against your house, your bank has actually secured their loan to you against your house. If you don't make your payment, they'll take possession of your house, right? Similarly, secured bonds are issued by companies where they say, okay, there's this real estate, like my plant or building or my inventory, which is secured. If I were not to pay or something were to go wrong, there is an asset which you can go and access. There is obviously a lengthy process, and we're not going to talk about that today, but you know there's some value underlying. Unsecured bonds are usually issued by very large companies. So public sector institutions who are billions and billions of dollars, they said my balance sheet is so big, so to issue 500,000 crores, I don't need to secure anything. Typically, unsecured bonds give you a higher return than secured bonds. Like today, taking a name, Tata Power were to issue a bond, they would say, everybody knows Tata. I don't need to secure. I have so many assets. And you would trust in that name and you would invest in that. Next, there are a lot of interesting questions coming, very smart questions. We will address this at the end. I will roll these questions back. This is the most important slide when you're doing an investment. Think of a credit rating like your CIBIL score. If your CIBIL score is higher, you will get a loan at a lower level, lower interest rate. If your CIBIL score is low, banks or NBFCs will charge you a high interest rate. Similarly, credit rating is the kind of ranking of the strength of the balance sheet of the company who's issuing you bonds. So if their rating is green, AAA, which means the interest rate will be lower, you'll make less return. So if you buy AAA bonds, you can make 7.25%, 7.5%. And as such, that's how the rating goes, AA plus, AA minus. This is nothing. It's very simple. It is just a ranking of the financial strength of the company, much like the CIBIL score. We highly discourage people not to buy BBB minus. They're they are higher risk. Unless your risk appetite is there, definitely buy them, but then study on yourself on these issuers. Important thing to note, these credit ratings are given by some of the institutions mentioned below, CRISIL, ICRA, India Ratings. All these credit rating rating agencies are also regulated by SEBI. So just remember, you buy a listed bond, it is regulated by SEBI. If something were to go wrong, you find credit ratings, that's regulated by SEBI. Exchanges are regulated. So you have a very good regulatory framework if you buy the right kind of bond. Risk is obviously your appetite. This is just an idea sample as to how to look at these credit ratings. And this is taken off some of the bond offerings on IndiaBonds. Somebody asked, who is IndiaBonds? Is a online bond platform. We are registered, SEBI registered platform where you can invest in bonds. So if you take government securities, typically give you 6.5%, 7%. I'm taking SDLs and government securities. AAA will give you 7 to 8%. AA you move will give you 8 to 9. So you really have to be familiar with your risk appetite and some of the name of the issuers to decide which rating suits your investment profile. Obviously, do your own due diligence and research and learn. It's your money, right? So you should spend some time learning about it. As a country, we've learned so much about equity and derivatives, as Mr. Krishnan said. Just learn how you can be a little smart, do a little bit study, and earn much higher returns than FDs with much lower volatility than equities. Let's go down. Next slide, please. Participants in the bond market, there are issuers. We spoke about government, corporates, public sector. There are investors. Do you know that everyone on this screen is actually, all of you, all of us are bond investors? What does that mean? Everybody does insurance. The premium you pay to your insurance company, or everybody does pension, they are the largest investors in bonds in the world, including in India. Insurance companies, banks, pension and provident funds are the largest investors. So indirectly, your money, which is going as a premium to safeguard your future, is being invested in bonds. There are obviously retail investors, institutional investors, a lot of companies who have a lot of treasuries handling 10, 100, 1,000 crores. They do not go and buy equity because they need that money for a future use. So something Mr. Krishnan has said, that if you need money for your retirement, you need money for, you want to buy a house in 5 years, you want to buy a car, a motorbike in 3 years, you want to send a child for education, you are not going to put in a riskier asset, but in a safer asset, which will give you consistent returns so you can build a little kitty and do your life objective. There are intermediaries. There are stock exchanges, BSE, NSE, credit rating agencies. They are merchant bankers. They are the people who bring these bonds to the market. They are depositories. Everybody has a demat account. CDS and an SDL are your depositories. Clearing corporation is where all the money and securities gets exchanged. They are brokers and dealers, which are regulated by SEBI. IndiaBonds as an OVP is regulated and is one of such bodies. RBI and SEBI. Next, please. When you're investing, what are red flags to look for? Number one, very important, unregulated platforms. There was a recent news in the newspaper about a certain issuer, having a fraud issue and the equity collapse and the bonds, the small amount of bonds. Importantly, all these bonds are bought from unregulated platforms, which means there is no SEBI license, there is no stockbroker or OBP license, because as a rule in India, if you are offering a listed bond on any digital platform to public at large, you need to be regulated. So these are the red flags. Do not buy from unregulated. Something goes wrong, no protection. Unlisted bonds, we said, do not buy, I would suggest, unless you've done due diligence and search yourself. High yield bonds. By high yields, I mean, if people are telling you this 15%, 16%, nothing is guaranteed. Every investment, financial investment, has a risk. Obviously, equity risk we understand, and the volatility. Bonds also have a risk. Apart from Government of India, everything has an incremental risk, and that's how you get a higher return. A 15% return is like an equity return. There are returns. If you do not understand risk, please do not invest. And that's a red flag to look at. There is no free lunch in anywhere in life. Structured bonds. Now, what do I mean by structured bonds? There's a lot of complexity around, collateralized bonds, or people offer structured SDIs and things like that, which are pool of loans. Now, as a common man, if you do not understand that space, really do you want to go there, right? People offer complex real estate financing based on a derivative. If you do not understand, stay with the simple, straight vanilla products. We can also make you 10, 12% if you have a high risk capacity. Next. What are the do's? Rating rational, always read the rating rational. All platforms have to list the rating report of the company that you're buying. So read, what are the rating agencies saying about the company, understand about the company. There's a full information memorandum which will actually give you balance sheets of the company if you really want to dig deeper, because it's your money. If you have a larger kitty to invest, or whatever amount of the money, just do some reading. These mandatorily have to be on the platform, information memorandum and rating rational. Diversification strategy. You have to optimize your portfolio. Definitely do not put all eggs in your one basket, right? People say even in equity market, don't put everything in one stock. So even within the asset classes, I think bonds give you that diversification. Comparative analysis. Do compare what is X giving you versus Y, which platforms are giving you better, and search and make sure that you make your money work. Next. Ideal investment portfolio allocation. I don't know which bucket you fall in, but typically 25 to 35 years old, people have a high risk capacity. People put 70% in equity, 10% in alternatives. These days, alternatives, I'm not a champion, so I'm not going to talk about it. Gold, crypto, whatever, etc. But fixed income has to be, because what happens if you lose your job? All your income avenues stop, but a fixed income or a bond will continuously pay you some income. You can match your EMIs by investing in monthly bonds. As you grow older, your risk capacity goes down and you diversify. Obviously, real estate becomes a bigger part of most of the people in India. Equity allocation should go down. There should be some growth capital. Fixed income should go up slightly, and alternative assets is as per your choice. Next slide, please. As within an equity portfolio, you diversify, right? You have mid cap, small cap, large caps. Within fixed income, an ideal allocation, again, it depends on personal choices. 20% you can keep in fixed deposit, low earning, but you feel that it's cash. DIGC in short for 5 lakhs for bank FDs. Because of the interest rate cycle, you can buy long dated government securities. What do I mean by that? 10 years, 15 years, government securities, if interest rates were to go down, not only would you make 7%, but there's a chance to make capital gains, and you could make a much higher return on a risk-free security. High yield should be about 10% plus, bond should be only 20% of your portfolio, which will give you the extra growth, and 40% should be the AA kind of a category between 8 to 10%. Next one, please. Online bond platform is a SEBI-registered tech-enabled platform that facilitates bond buying. People want to ask what an OBP is. Next slide. Key risks. As I said, nothing is safe. Key risks of bond investment: one, liquidity risk. What do I mean by that? Now, the lower the rating slide you go, the bonds are less liquid. So if you were to buy a government security or AAA, you could almost trade in and out like 100 times a day. Okay, because they're very, very liquid, very large markets. But obviously, if you buy a single A high yield bond, the liquidity risk is there that suddenly at some point of time, it might take you some time to exit if you wanted to. Obviously, bonds are hold to maturity. People like to hold to maturity. But in case you need cash, that's where you're getting paid the higher return, right? 10, 11% you're getting paid to take some risk. Fraud risk. Fraud risk is not much we can do about it. You can see red flags, but frauds do happen, unfortunately, and that can impact. And hence we say you build a portfolio of fixed income itself, not only just buy one or two bonds. Market risk. By market risk, I mean, interest rates can go up and down. If interest rates go up, your bond prices go down or affect your portfolio. Thankfully, interest rate cycles move in 3 to 4 year cycle. We are an interest rate cut cycle. So actually there's chance to make even capital appreciation on your bonds. There could be other market risks, there could be war, there could be some kind of a global stress or a global impact like this US-China tariffs had, which will impact market sentiment. Credit risk is most important as the health of that company. That's how rating agencies actually tell you from time to time if credit ratings are going down or up. You should study yourself to understand credit risk. Next one. I think we're coming to the end of the slides. There are a lot of e-learning programs. I'm not a champion, but NISM and FIMDA obviously have a lot of courses that you would want to learn on the debt markets and interest rate derivatives and fixed income mathematics. Next slide, please. Anything to learn about bond investing, you can download IndiaBonds app as well, or go and search on that. It has a lot of education material. It'll help you to navigate, and you can figure out how to invest in fixed income in a step-by-step. It has a lot of fancy tools like bond calculators and portfolio analysis, which will help you learn more about that. Next slide. All right, we're open for Q&A now. Should we stop sharing screen? I will go up to the questions. Mr. Krishnan, if you want to come in, please, I would love to get your expertise. Some of the questions I picked up: bonds better than corporate funds. I think you touched upon that. Maybe you want to just repeat that for the sake of our audience. How investing in bonds directly are better than debt funds or something like that, or corporate funds. Sir, you're on mute. We cannot hear you. Sorry, if you could unmute. You're on mute. Yeah.
So I think we initially what happened is that indexation was allowed for bond funds. And subsequently, what happened is that the tax laws were changed and the indexation benefits were removed. But there is an advantage in bond funds, which I must also talk about, having been a bond fund manager at some point of time. And whereas if you look at bond fund managers who understand the market, they have the ability to manage duration, to generate sort of capital gains on your portfolios, which a held to maturity bond, an individual who buys it on a held to maturity basis may not be able to generate. So therefore, if you buy a bond that is giving you, say, a 7.5% coupon and you hold it to maturity, you get a 7.5% cash flow right through. But if you have an active bond fund manager who's able to sort of read the interest rate cycle correctly and trade on that, he can generate up to 10, 11% also. In fact, you've seen in the recent rate cut cycle, many bond funds have performed extremely well, right? So there is some logic of looking at bond funds. There's another interesting take that I had on bond funds. And there are many bond funds that are the shorter end of the market that run, say, a 3-year medium term to short to medium term bond fund, where they ladder their portfolios. So they have a 1-year bond, a 2-year bond, and a 3-year bond, which gives them the ability to be on the top of the interest rate cycle. So if, for example, interest rates are moving up, you have the 1-year bond that is maturing, and therefore you can put that money at higher interest rates into a 3-year bond, and then in the next year, this 2-year bond matures. So, this laddered strategy sometimes is very difficult for, an individual to do. And therefore, there are advantages of bond funds, and having some bond funds in your portfolio also makes sense.
Yes. Thank you. Yes. So I think what we are saying is if you invest directly, you can be in control and earn higher returns. In bond funds, you'll have to go and search. One of the next question is SDI or PTC more secure than bonds? I think it depends on the ratings because a lot of companies or corporates are also rated similarly. PTC technically are more secure. SDI depends on the pool risk, right? So personally, I would discourage people who do not understand bonds to get into structured instruments like SDIs, but PTC, I think, is relatively safety. Next question. Regarding the safety of principal invested, FDs are insured for 5 lakhs. Nothing is principal, nothing is guaranteed safety. But obviously, if you were to invest in government securities or AAA institutions in the country, then they never had a reason of default. They've never defaulted in the history of India, right? So banks have had stress. So even FDs in the large banks are as low as 6 to 6.25%. Then you go to small finance banks, which are 8.5%, but you're taking that incremental risk. So just to tell you from market knowledge, small finance banks, which give you 8.5%, 9% FD interest, actually have subordinated bonds, which give you 11% interest, right? So FDs, I think our parents and grandparents always taught us, but now the markets have really moved and developed. Technology information is available, and it should make your money work a little better if you do some more search. Okay, next question. So would a secured government bond be the gold standard of safety? I don't think the government of India would secure the bond. अगर government ही नहीं है तो मतलब country क्या है? So I think there is no country in the world secures the government bonds. Are all secured bonds truly secure, irrespective of ratings? Have investors lost money? Yes. Credit ratings is a cycle. Credit is a cycle. In India, we have very tremendously cleansed our credit cycles. 2016-17, there was a regulation called Indian Bankruptcy Code, which gave the strength for defaulting companies or investors to recover money from. And public sector. So there were a couple of defaults in India in 19, 20, 21, but all that has been cleansed. There's a regulatory framework. It is like saying nobody remembers when Nifty was 8,000, right? So yes, there were some bad times where awareness was not there or people did not know about it or there's some frauds and that happened. But nowadays, I think the regulation around rating agencies and things are much, much stronger as we were in the past. Would you like to, sir, add anything to that as to how things were and how things are in terms of bonds? As people said, can you lose money on bonds, right? Secured bonds.
So I think we're talking about two things. One is, can you lose your principal?
Yes.
Idea is, there is a very, very low chance of losing your principal especially if you are on a AAA rated bond. As I told you, both the default rate and the transition rates, that is the rate of a bond moving from AAA to AA, from AA to A, are very, very low in India over the last couple of years. So the chances of losing your principal are very low. But you have to remember that, there is something called an interest rate cycle. And what would happen is if you needed to exit a bond early, right, you could have a mark-to-market loss. So it is not that you will be able to exit that bond at whatever face value or principal, purchase price you bought it at. So you could have a mark-to-market loss if you wanted to exit early. But if you hold it to maturity, there is an almost certain chance that you will get back all your money.
Yeah. What are zero coupon bonds? Zero coupon bonds are basically where the interest payment is not periodic, right? So if I borrow money for 2 years, again, friend Ashish says 1 year, every year I'll give you interest. But if he'll say, okay, give me 10,000 today, after 3 years, I'll give you 15,000 rupees. So that becomes a zero interest with a lump sum. Money comes to you if you don't need regular intervals. It's a good way to save, right? For people. Just remember, zero coupon by bond mathematics has the highest sensitivity to interest rate movements. So like now, if you think we're in the reducing interest rate scenario, if you were to buy zero coupon government bonds, I think you can make a lot of capital gains on that if interest rates were to be cut further. What percentage of a portfolio should be invested in bond market? Again, it depends on your life cycle. We touched upon that. Everyone should have at least 15-20% of your portfolio in fixed income bond instruments. As you grow older, I think the propensity to take or the desire to take risk it reduces. You want more stable income, especially retirement plans and all that. And your allocation should go up as high to 40 to 50%. What is the taxation on bonds? Okay, very good question. The interest income, we are not tax experts, so refer to your own tax expert, but basically the interest income is taxable at your slab rate. So whatever rate you are paying for, and there's a 10% TDS, tax deducted as source, for all listed bonds in the country. You can apply for 15G, 15H form, either if you're a senior citizen, for that tax not to be cut directly to the company, or if your taxation slab is low. But they are taxed, the interest income is taxed at your slab rate. Difference between bond and debenture, sir, there is no difference. Corporate bonds traditionally in India have been called debentures or non-convertible debenture. They're exactly the same thing. Bond and debenture is the same fixed income bond instrument. For where can we buy various bonds? As I said, you can buy from online bond platforms which are regulated by SEBI. The list of OBPs are available on SEBI website. IndiaBonds is also one of them. You can decide where to buy. There are multiple of them around. Minimum investment period in bond market. So there is no lock-in. If you buy listed bonds, there is no minimum investment period. You can technically buy today and sell tomorrow, as long as the bond settles in your thing. So unlike traditional fixed income instruments, like a pension or an NPS or even RBI floaters, you have a 5, 7, 10-year lock-in period. Corporate bonds or government securities, investing in them have no lock-in period and they are tradable. In the past, we saw write-off of 81 bonds, like in case of Yes Bank, where the secured bonds can save investor in this case. You are actually correct. You know, secured bonds would rank higher than 81. 81 was the additional tier 1. If people studied that, tier 1 bonds came into existence about 25 years ago, very rapidly in Europe, basically saying if there's a loss in bank or loss absorption, these securities will be written down. And believe me, we were not the only country, Yes Bank situation, but Credit Suisse, which is a large Swiss bank, which was taken over by another Swiss bank, they wrote off $15 billion of 81. The structure of 81 depends on what is written, that if the profitability of a bank, which is very important to a financial structure, goes, then these securities will be written down, and that's why they pay you a higher interest. In India, no public sector 81 bank has ever defaulted. In fact, there was a situation where government topped up by equity and also called and redeemed 81s earlier. So when you buy a secured bond, it is better by structure, financial structure, than an 81 bond. I did not understand this question. In reducing interest rate, companies go for foreclosure. Companies cannot force you to redeem your bonds. Just remember, even if interest rates are going down, unless they have unless there's a call option. A call option means that if a bond is issued for 5 years and there's a call option after 3 years, a company can call back its bond and pay you money back. Okay, that's usually a case when the interest rates are going down, or the company is really improved in its credit rating. Some questions on taxation. I'm afraid there's a lot of material on the internet. I am not a tax expert, so I will stay away from that. But long-term capital gains for any appreciation on your bonds is standard LTCG at 12.5%. Okay, that's okay. One question, very interesting. One more advantage of bonds, somebody writes, is that when company goes into liquidation, bondholders will be preferred over equity. You are absolutely right. If a company were to default or go bankrupt, bondholders are loan givers to the company, so they will have the first right. In fact, secured will have even the first better right for money to get back. And usually, unless all the creditors are paid off, equity holders will not get any money, or usually zero. What is yield? So the definition of yield is just means returns. Yield on a bond means if you were to buy this bond today at this price and hold to maturity, that will be a total return. Now, why is coupon and yield different? Coupon is the interest rate decided at the time of the issuance of the security, but the price of the bond, as Sir said, can go up and down. If you buy a bond below its issue price, you will have an yield or return higher than the coupon. If you buy a bond higher than this issue price, you will have yield or return lower than the coupon. What steps you suggest to popularize bonds with pensioners? I think that is why this session is being held, and thanks to thanks to NISM about capacity building. This is our humble effort, continuous monthly effort to educate people. And do you hope you sign up to these webinars or tell your friends and family to sign up to NISM? A lot of educational webinars that are held. Okay, there's a gentleman who's repeated a question 8 times, but sir, we've answered your question. Investing in FDs that's secured to 5 lakhs, guarantee on 9% interest on bonds. I think you have to do your study on who the issuer is on the 9% bonds. It's typically an A-rated institution. It depends on your risk appetite. You should have a portfolio approach to these things where you also have the FD and you also have a 9% bond, because historically, the default rate is very, very low. Is MLD better than bonds? MLD is a kind of a bond structure. I'm running the questions because we still have 9 minutes to go. MLD is a market-linked debenture. What does that mean? That the return on that depends on something else. So in India, a lot of MLDs were issued based on Nifty returns. So actually, वो आपको bond कह रहे हैं, but it is not a bond. It's a structured product for taxation purposes. Regulator does not look at it very kindly, and a lot of tax benefits regulation was changed 2 years ago against that. If you're buying a bond, you're buying for stability, regular return. If you're buying an MLD, you're buying for something else. Yes, there are convertible bonds. We are not going to talk about convertible bonds. There are a lot of nuances. Simply explain, a convertible bond is issued by a company which pays an interest and that converts into equity after a certain amount of time, depending on an event or a price. Mr. Krishnan, would you like to add anything? Because, as the questions come, maybe how can bonds be traded which are listed? What happens to investors who initially purchase bonds? So, very good question. Bonds can be purchased when they're issued, right? What we call a public issue. Maybe someone who bought it initially wants to sell it, and that's how a secondary investor can buy it. You also have active mutual fund managers, as sir said, who buy and sell bonds, right? So there is a liquid market, not as liquid as equity, but government security market is much liquid where you can buy and sell bonds. And that's why a lot of the offerings on platforms are actually secondary bonds and also some primary subscription. There are a lot of specific questions to IndiaBonds. You can write to us on contact us at IndiaBonds and somebody will help you. For NISM questions, you can write to NISM. How can we get loan against bonds? Very good question. There's something we're trying to work on to make it more liquid. Obviously, in India, loan against mutual funds and equity is pretty rampant. But loan against bonds is something that can be worked as a good product, and we're working on this. How to invest in 𝐒𝐸𝐞𝐚𝐤𝐞𝐫? Very simple. You can either go to RBI Retail Direct Portal if you're a retail investor. There, just the difference is you get a security as a general journal entry, or you can go to an online bond platform, including IndiaBonds, and invest in a 𝐒𝐸𝐞𝐚𝐤𝐞𝐫 in a DMAT demat form, so you can see it. But it's very liquid. You can really trade 𝐒𝐸𝐞𝐚𝐤𝐶 very actively or buy and invest in it. Bonds cannot be purchased without DMAT. For any financial security investment in the country, you need a DMAT account. Without that, you cannot purchase a bond. Can bond be used as a collateral in trading? We are not stockbrokers, but we do believe that equity brokers do take government security as collateral for trading. I think we are close to the end of the question. Minimum ticket size for bonds, you can start from 10,000. Historically, there used to be 10 lakhs 2-3 years ago. SEBI brought it down to 1 lakh and then now to 10,000. So usually you buy bonds for 10,000 or 1 lakh. I think just one last minute, any last questions? Otherwise, we will wrap up. No, 10,000 is not for all bonds, 10,000 or 1 lakh. Funny question, if you want to buy a bond, which one will you invest? We are not here to talk about anything specific issuer. As I said, a good portfolio is important. You should see what your risk appetite is. If you're a first-time investor, start with a government security and AAA and build a diverse portfolio. Yes, we will all get participation certificate. Will be sent by NISM in 2 to 3 working days after that. Great. So quick, who all enjoyed this session, thought it was informative, please give a thumbs up or a yes in the chat. So we know, how we can constant journey for NISMS to improve. I think there is a survey at the end. It was really enjoyable for me talking to Mr. Krishnan with his experience. But do fill in the survey. It'll always help us to make these sessions better. Mr. Krishnan, some closing comments from you, please.
Yeah, thanks, Vishal. That was a great presentation, and I think you covered great ground. I mean, so you've demystified, a lot of, a lot of the stuff that let us say, the normal investor sort of finds
Yes, doesn't. Yeah, yes, sir.
finds difficult to understand. And clearly, corporate bonds are a little more complicated than sort of equity, and therefore it does sort of need some explaining. But coming back to one very fundamental question that quite a few people asked as to, how much of my portfolio, my personal portfolio should be in bonds. I just thought I'd spend a minute on that, saying that, fixed income has always been part of everybody's portfolio. At some point of time, you've got money lying in your, savings account, in your fixed deposits, in your, people like us say, senior citizen schemes, in your annuities, in your insurance, as you rightly said. So you always have some bit of fixed income that is there in your portfolio. But I think the beauty of online platforms is that it now allows you to replicate that at an individual level. And therefore, I think, even at the short end of the market, instead of going in possibly for a liquid fund, you could get into a short maturity bond. You have money that you got for 1 year, which you otherwise have kept in a fixed deposit. Go and buy a 1 year maturity bond, because you will get 1 year maturities or 2 year maturity bonds on the platform, which could be AAA 1 year maturity bonds, which would give you rates possibly better than what a fixed deposit is giving you. And if it's giving you that, then please go into doing that. Similarly, if you are somebody who's retired and is looking at retirement income, it's sometimes a very good idea to go and buy a long-dated government bond. So what does an annuity service provider do? An annuity service provider takes your money, invests it into a 30-year GSEC, and charges you 2% for it. I mean, why should you be paying 2% to that annuity service provider? Couldn't you just go back onto a platform, buy a 30-year bond or 20-year bond, depending on how long you think you're going to live, and save on that 2%? It'll make a huge difference to the kind of cash flows that you get on retirement. So I think there's tremendous possibilities for every portfolio to sort of invest and benefit from bond investing.
Absolutely, sir. Very, very right. And again, I would like to just thank all our participants. Thank NISM for this opportunity. To build this awareness. Some people are asking, can we get the presentation? I think it goes up on NISM and our respective YouTube channels in about 3 to 4 days' time. So you could always visit and try and revisit. But share the good word. Let's build, make people more aware. This is all about financial inclusion, financial awareness, where people can optimize their own finances to the best needs and best utilization for yourself. And yes, you will get a certificate. A lot of times the questions being asked, but goodbye from IndiaBonds side, and namaste, and thank you for everyone for being here.
And thank you from NISM side too.
Yes, can we close the webinar now?
Thank you. Yes. Thank you, Mr. Krishnan and Mr. Goenka, for your time and sharing some amazing insights with us today. We're truly grateful for this opportunity, and we look forward to hosting our audience for the next webinar very soon, next month. To be informed, please follow NISM and IndiaBonds' social media channels. And a big thank you to our audience for your proactive participation and very interesting questions. If you have any further questions, please feel free to reach out to us and send us an email at contact us at indiabonds.com. And for NISM, please reach out to NISM. Certificates will be delivered to your email inboxes, the ones that you've registered from, in 2 to 3 days' time. Typically 3 to 4 days, you should definitely get it. That's about it for today. Hoping to see you soon. Thank you so much.
Investments in debt securities, municipal debt securities, securitized debt instruments are subject to risks including delay and/or default in payment. Read all the offer-related documents carefully.